You're watching Asia Fest. Greater China markets open a mixed day after the EU said it would impose additional tariffs on electric vehicles shipped from China starting July. Specific levies were set for EV makers BYD and SAIC Motors. BYD shares are up more than 7%. NIO also trading higher by about 4% there, while SAIC Motors is heading in the opposite direction, down more than 2%. But broader market sentiment is mixed, with Shanghai Composite and Shenzhen, they're ticking lower this hour, but the Hang Seng is up by more than 1%. And to help us make sense of all of this, let's bring in Kingsley Jones, CIO at Jevons Global. Kingsley, so we're seeing, kind of upbeat trade among those Chinese EV names. What is keeping them, so positive, keeping traders resilient? Are they well placed to weather these tariffs from the EU?
I think that is the message from the market, and let's just try to understand why that is, because it may seem a bit counterintuitive. But when you introduce tariffs such as these are, they are on different scale depending on which manufacturer. So, SAIC is, I think, 38.1%, Geely 20%, and BYD 17.4%. So through this action, they're actually making a differential pricing regime on Chinese EVs. Now, of course, BYD has the lowest of those tariffs, and they're also the market leader. So this is only going to cement BYD's leadership in the marketplace. And I would point out that BYD also has some pretty cheap product, like the Seagull, that retails, I think, for around $10,000 to $15,000 US. So I think that competitively speaking, this does a lot to actually boost BYD's leading position. And I don't think it's going to keep those cars out of the European market because they actually compete very well on price and quality, even with the tariff. So I don't think this is going to really take much wind out of the sails for selected Chinese EV makers. And that's why I think the stock is up 7%, as you see.
Yeah, so not really, putting the brakes there on China flooding Europe with its EVs. What about the real risk of auto inflation in the EU then with these tariffs?
Well, that's the problem. I mean, the period when we had high tariffs and protection last time was during the 70s, and that was the period of stagflation, high unemployment, high inflation, sluggish growth, and a pretty terrible economy. And we seem to be, I don't know for what reason, we seem to be repeating those policies, at least in the West. So I do think that in Europe you will see vehicle inflation. I don't think it's going to help European competitiveness in the long run. And I don't think it's going to prevent the leading Chinese makers from extending their lead. So it's all a bit perplexing as to why you want to do this. But there we go. That's what they've done. So we'll just have to see what happens.
Yeah, and your calls in your notes to us, you said that, we also like China EVs through BYD and Xiaomi. So how are you going to be revising your calls when it comes to Chinese EVs, or are you still going to be overweight on them or heavy on them?
Well, we still like those too. I think because of these differential tariffs, Geely's only slightly above BYD, and they have an extensive range of vehicles because Geely, as you know, it's a conglomerate, has a whole bunch of different brands. So we'll probably have a closer look at them. I think they could be a beneficiary of this also. But it's too early to tell, so it just requires some research. But in terms of those favoured names, Xiaomi and BYD, we haven't changed our call there. We still think it's pretty strong for both companies.
Yeah, and do you expect this momentum to also spill over to China's new energy sector? That's been a growth area. It's been pretty attractive for lots of investors.
Yeah, I think it's getting closer to the time where you would buy some of the Chinese solar makers. They had a very difficult year last year because the thing about China is they've been very effective at growing the scale of their industry, and periodically that leads to overinvestment whilst demand catches up, and that causes prices and margins to fall. But we think that's plateauing now. The main driver, I would add, for these cost reductions we see in Chinese product is a very high degree of automation in their factory system. They've responded to the fact that their population growth has plateaued to negative. And so they're putting robots in. So I think new energy sector will be a bright spot in China, possibly the second half of this year. So good time to look at those companies.
Right. And if we just zoom out a little bit, we're looking at rest of Asia trade this morning. That's looking pretty good following their Wall Street peers after the cooling inflation figures and also as the Fed signaled just one cut this year. So your top calls for Asia amid a more conservative Fed?
We remain pretty bullish on Japan. Notwithstanding the weak domestic economy, that low exchange rate and what looks like rate cuts coming, I think that's going to support, the Japanese exporters or the trading companies. So we really like, Toshu and Marubeni and Mitsui and other of the big trading houses. We also we think that the Japanese semiconductor equipment manufacturers, they had a bit of a pullback. We think it's probably time to look at those again. Tokyo Electron, Screen Holdings, companies like that. And then I think also in the material space, we like Shinetsu Chemical and a few others. But I'd also add, in Hong Kong generally, I think it's a good time to be looking at the Hong Kong market.
All right, Kingsley, appreciate your time this morning. Kingsley Jones, CIO at Jevons Global.